Welcome back. We're going to Module 5 on page 6 of the outline. Again, if you have not downloaded the outline, be sure to do so. The link is right there on the Series 6 page. I also recommend, as I have several times, you take it down to an office supply store, get it bound like so you can have a place for notes out here and have everything just all right there handy. We're going to talk about some other securities, just stuff that doesn't fit anyplace else, and really just familiarity with those and going into the trading markets and some of the terms that we have that are associated with that. So basically we start out with stock rights or rights, and these are used to exercise what's called preemptive rights. Now, preemptive means that I can basically go to the front of the line. I can, if we preempt well, in fact, last night we had some pretty heavy weather in Tulsa. If you wanted to watch your favorite show on TV, you were just out of luck because all the network stations would preempt their normal programming for weather coverage. That means that they took that and they put it up in front of their normal program so that all you could see was just the weather coverage. Same thing here is that if companies issue new stock and I have preemptive rights, then I go to the front of the line, and the general public, they don't even get a chance to buy that stuff until I get my chance. Well, how do I do that? It's with the security that's called rights. A couple of characteristics of rights that are important to remember is that they're short term, because let's see, why is the company doing this? Because they need to build a new plant. They've already hired the architect, they've already got the plans, they've already got the estimates, they've got the contracts that are sitting there waiting to be signed. They want to do that right now. So rights are right now securities, typically about 30 days, okay? They go to existing shareholders, because why am I picked to go to the front of the line? Because I own some of the stuff already. And they want me to be able to keep my same percentage ownership. There it is, maintain a proportionate ownership. Here's what you've got with rights, okay? Here is the pie. There's my slice. I'm going to make that pie bigger by issuing more stock. The only way I can keep my same percentage ownership is to buy that much. That's what rights allow me to do. Maintain that same proportionate ownership. Okay, so that's rights. Now the thing is, what if I don't necessarily want to buy all that stock? What if I'm Aunt Millie and I get my notice and I say, oh, I'll have little Bobby look at this when he comes in 3 months from now. Whoa, 3 months from now, the darn things have expired, right? I lost my chance. There may be some stuff left over. Well, the company wants to make sure that all of that gets sold. So what they'll do is that they will contract with a standby underwriter. Let's read that one backwards, okay? That's an underwriter, somebody who pays for the whole thing. Like if I'm going to underwrite the opera, I'm going to pay for the whole opera, and then I'm going to hope to get my money back from ticket sales, right? Yeah, okay, so I'm going to buy the whole thing. But how am I going to buy the whole thing? I'm going to do so on a standby basis. I'm just going to be in the wings, and after all these folks have done all their, oh, we've still got that much left over, I'll take it. Here's your check. Boom. Okay? I have made a firm commitment to do that. Standby underwriter goes along with rights offerings. Okay? They're going to buy those unsubscribed shares. Now, warrants, I've already let the cat out of the bag. I'm from Oklahoma. As an Oklahoman, a little bit of a redneck. One of my favorite shows is Cops. Love Cops. I mean, I just can't believe some of the things that go on. Anyway, one of the things that happens a lot is that, in fact, my favorite scenario is when they pull a guy over for a traffic stop. The driver is okay, no problem, but they run the ID on the passenger, and the passenger has some warrants out. The passenger goes to jail, and they say, get that taillight fixed. I know why. I just love that scenario. Okay, well, what about that warrant? When was that thing issued? Man, I don't know. Probably a long time ago, okay? Same thing with these warrants. They're long term. They could last for several years. And like I say, that's it. So it's used to make a financing package much more attractive. Let's put ourselves in the shoes of the borrower, because it's easy. You can attach these things to anything, okay, but it's easiest to understand with regard to debt. Let's say that we need to borrow $10 million for a startup company. All right? The bank or the lender, whoever it is, says, man, you know, we'd have to charge you 22% interest, but we can't operate on that. So I tell you what, we really believe in your concept, and we really believe in what you're doing, and you've proven your concept, etc. We'll loan you the money for 9%. 9%, that's great. But we want an equity kicker. We want to ride that rocket. We want to get more than just our money back in case you do take off. So we want some warrants attached to our IOUs. Okay, we'll let you buy this much at this price for this period of time. And if in that time period, then guess what? Right there, you can buy it here, sell it there, boom, and you'll ride the rocket with us. Okay, so that's a warrant. It's a sweetener, not to existing shareholders, but to new investors. Options, calls and puts allow for buying or selling at a contracted price. On this test, if you see options, it's probably going to be in the answer, and it's probably going to be one that you can eliminate. You can't trade options. You can't, I mean, on the Series 7, you got to know them like the back of your hand. But this test, there's one possible answer. You read the term backwards. That's an option income fund. What is an option income fund? Well, it's a fund that derives its income, at least in part, by selling options. I doubt that you see that one. So like I say, options, typically going to be the wrong answer for you. And then American Depository Receipts or American Depository Shares, ADRs or ADSs. Exactly the same thing, all right? They allow for trading by U.S. investors in foreign securities. So if I wanted to buy Sony, I would either have to go to Japan, do the currency conversion so that I could buy Sony on I don't want to do all that stuff. I just want to go out to the New York Stock Exchange and buy dollars, pay dollars for it. But what I do is that I actually buy an ADR, an American Depository Receipt. Some bank somewhere bought a ton of Sony stock, put it in a vault in their basement, and then came back and issued in the United States receipts for those shares. Okay, you can go into a lot of operation there. I wouldn't worry about it. What you need to know is that because of the fact that I don't have the real thing, I don't have any voting privileges. The bank owns the real thing. The bank has the voting privileges. Wherever the basement is, okay? That's who has that. And then dividends are declared in the foreign currency. Yeah, Sony declares their dividends in yen. But what do? They pay that dividend to the bank. The bank then does the magic on it, converts it to dollars for me. So I pay dollars when I buy it, I get dollars when I sell it, and when I get a dividend, I get dividends in dollars. So they're paid out in US dollars. But then holders are subject to a currency exchange risk. Remember, Sony declares and pays the dividend in yen. How many dollars will those yen buy? It could be more, it could be less. And that currency exchange risk, that just marries up with ADRs or ADSs. And then restricted securities, you may see that term, I don't know, we'll cover it. That's securities that for some reason have come to market without going through SEC registration. And when we get to the 33 Act, we'll talk about those and how they get there. But there are things that under normal circumstances would have to be registered. There were extraordinary circumstances, so they didn't. So going on over to page 7, we'll start on the securities markets themselves and the market terms. You have exchange markets, which are auctions, okay, New York Stock Exchange or the American Stock Exchange. There are also regional exchanges. I'd just be aware of that. You probably won't have to need to know more than that. And you have securities that are listed on these marketplaces. It is an auction market. And so basically what happened, for this to make sense, you've got to just remove all the technology in the world, okay? You really do. Maybe telephones, maybe telegraphs, all right? And think about it, okay? What we've got is we have a centralized marketplace, and XYZ is listed, therefore it trades there. And what you do is you've got a buyer, and you've got a seller, and the agents or brokers for these folks, they will take those orders out to this centralized marketplace, and they'll conduct an auction. Okay? back before we had so much technology, that was a huge, huge advantage. Because if you want to see what something is really worth, you put it up at an auction, get ready, willing, and able buyers together, you'll figure out pretty darn quick how much it's worth. Okay? That's what we did. Now technology has changed, and so you have over-the-counter markets with a wide variety of securities, not only stocks, but also almost all your bonds are going to trade in the over-the-counter market, and you have negotiated trades. Now here's what I mean, okay? If XYZ were not listed here on the exchange, then what would happen? This buyer would have to go to the broker-dealer, and the buyer, or the broker-dealer then, would have to contact other broker-dealers of potential sellers. They may or may not have anything that they would want to sell out of their inventory or on behalf of a seller. Okay? But if this guy had a lousy price, this guy had a great price, you might come to this guy who had a so-so price and say, well, you know, I got a really great price up here. Can I get just a little bit less than that just so you can do a trade? Again, if you've got, remove all the technology, makes a lot of sense. Okay? Now technology means that all of these guys are going to have almost exactly the same price. And they're also, you're going to get the best price, just almost either environment. But in any event, it makes a lot more sense when they're having to do it manually. And that's the over-the-counter market, because we will just, like I say, broker-dealer to broker-dealer, and negotiated transactions. And the securities firm actually can act as a broker, always a broker in this situation. Or what could happen is that this guy could contact his broker-dealer and say, would you sell this for me? Okay, in which case, if this one did the trade, it would act as a broker because the stuff would go right there. Okay. Or this one could take it out of their inventory, in which case this would act as a dealer. You can either act as a broker or a dealer, not both, on any one given trade. All right, so anyway, there's our over-the-counter market, and NASDAQ, the NASD, National Association of Security Dealers, automated quotation system. NASDAQ, the folks there are master marketers. I mean, I'm really impressed because they talk about the NASDAQ market, NASDAQ stock market, like you can go there on vacation, get one of those stickers you put in the back window. There is no such place. It's just a bunch of wires and computers. That's all it is, okay? In fact, the NASDAQ market site, sometimes you'll see, it's just a bunch of TVs in Times Square. That's all it is. No trading goes on the NASDAQ market site. It's just an automated quotation system. And so let's look at that quotation system, levels, different levels of it. Level 1 shows subject quotes. What are they subject to? Subject to somebody coming in and buying it, somebody changing their mind, okay, so it's subject to change. And it's going to quote the inside market only. Now the inside market, okay, think about eBay for a second, okay? When do you win the auction on eBay? It's when you bid the highest price, right? Yeah. So you've got bids that start out good and get better and better and better, and that guy has the best one. Now, if you went to a parallel universe where you had multiple sellers of exactly the same thing and only one buyer, which one would you buy from? The one that asked or offered, not this guy, he's asking way too much. Not that guy, a little bit better, better, better. There you go. The highest bid, the lowest ask. Okay? That's going to be your inside market. So just think of eBay, highest bid wins, and then you got, like I said, go to parallel universe eBay, the lowest ask, lowest reserve price basically. If there are 7 items that are identical, they're all new, they all have reserve prices, which you're going to go for? The one with the lowest reserve price. Okay. So anyway, that's level 1. Level 2 though, level 2 is where your market makers live. The guy on the trading desk, or excuse me, the guy on the trading desk, he's got to know that if he punches that button, that he's going to be able to buy that stock or that bond. He needs to know that if he punches the button, he's going to be able to sell the security. And so those have to be firm. All right? So they'll see not only firm quotes, but also firm names. Not only how much, but where is it? A trader has to do that. And then somebody's got to say, you know, I need to raise my price, I need to lower my price. So the actual market maker himself that's responsible for pricing goes to level 3, where you see firm prices, firm names, and you can make changes. So the deeper you go into the system, okay, Bob goes in, looks at the computer that's on the counter, he's going to see level 1. The actual trader is going to see level 2. The fellow or gal who's in charge of pricing is going to see level 3. And then you have NASDAQ Global Select Securities. Those used to be called NASDAQ National Market, so I doubt that that's been changed long enough. I doubt that that term is still in there, but just in case, they're interchangeable. The important thing is that you actually have last trade information, just like you had on the exchanges. All right, so the NASDAQ Intermarket, or the third market, okay, third market is, again, you've got to go back in time before, for these to make sense, because the first market was the exchanges, the second market was the over-the-counter trading. The third market is a variation on the over-the-counter trading. Okay, that's where we have, let's see, 1 + 2 = 3. So we have a security that's listed on 1, but it trades in 2. Okay, now, what you'll be able to do is you'll be able to, on your third market or NASDAQ intermarket question, is that you'll be able to boil it down to a listed security trading in an over-the-counter transaction, or an over-the-counter security trades in an exchange transaction. Remember this, okay? Didn't leave myself enough room on the sign, but it doesn't matter. There we go. Here's the New York Stock Exchange. Got a big sign in front, members only. If you ain't listed there, your stock ain't gonna trade there. Microsoft has chosen not to list Microsoft stock on any exchange. Therefore, if they said, just this once, I want to do a trade on the floor of New York Stock Exchange, they're gonna say, come on, give me the papers and pony up on the fees. But you can't do that. Okay, so it has to be a listed security that trades in an over-the-counter transaction. That's the NASDAQ Intermarket, or third market. The fourth market is direct institutional trading without intermediaries. Instanet is one of the systems that they use, and so you can just match up those terms and know what it is. Okay. All right, I'll tell you what, those are the marketplaces. At this point, we actually start to go into the participants and the terminology that's used. So let's go ahead, and it's kind of a good place to have a breaking point. So let's wrap up on this segment. We'll pick up then on page 7 with brokers and dealers and some of that market terminology then on the next module.